US Treasury yields jump on growing expectations Donald Trump will win the US presidency and run loose fiscal policy. European stocks rise after a smaller than expected win by France's right-wing parties. And the yen hits a fresh 38-year low. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior economist Birch explains how Australia's inflation cycle compares to the rest of the world and why services inflation is so sticky.
It'll take a bit more time, we think, for that demand to come back in line with supply. But you look at things like some of the business indicators, for example, that is showing a bumpy path back to target.
But first, in 5 and 5 with ANZ, there were big market moves overnight driven by political developments. The yield on the US 10-year Treasuries rose 14 basis points to 4.49% overnight. And the 2-year rose 6 basis points on growing expectations Donald Trump will win the US election. That would increase US borrowing and inflation, many think. European stocks lifted after France's first-round election results showed right-wing nationalist parties winning by a smaller than expected margin. Meanwhile, the yen slumped to a new 38-year low of 161.58 per US dollar overnight. That followed some weakness in the Tankan business survey, although inflation expectations rose, which ANZ FX analyst Marja Ben-Zaman says should be welcomed by the Bank of Japan.
Confidence around the non-manufacturing firms, however, was a little bit softer, particularly in the retail and consumer-related activities. This really does signal that the cost of living squeeze is impacting household spending. A mixed picture on the mood and the sentiment around Japanese businesses, but inflation expectations broadly higher on a longer-term basis, which then cements the view of a likely rate hike by the Bank of Japan at their next meeting.
The US dollar index was firm along with those Treasury yields. The Aussie dollar is at 66.54 US cents as of 5 a.m. Sydney, Melbourne time. That's down 0.19%. While the Kiwi is at 60.73 US cents, also down 0.19%. Number 2. In Australia's jobs market, the ANZ Indeed monthly job ads series for June showed an intensifying fall, says ANZ Australia economist Maddie Dunk. Job ads fell 2.2% in June from May, which was the 5th consecutive drop, and took the annual fall to 17.6%. Maddie is also seeing the beginning of the end of job hoarding, which has held up employment until now.
We've seen that a lot of the adjustment in the labour market has come through a fall in hours worked. So it's that labour hoarding story where people say, I want to hold on to my workers, but everyone can work a little bit less. And a lot of that adjustment seems to have run its course. So we're back seeing that hours worked is around its long run average trend. So from here, it is likely that you'll see employment growth start to slow a bit, and that might lead to a modest lift in the unemployment rate.
Number 3. The minutes for the RBA's June board meeting are out today. ANZ senior rate strategist Jack Chambers says the focus will be on whether there's any additional hawkish commentary to the governor's remarks that a rate hike was discussed.
We saw in the post-meeting statement and then in Governor Bullock's post-meeting press conference, they struck a much more hawkish tone than most people, including us, anticipated. Since then, we've had the strong May CPI print, which won't be reflected in the minutes. But what will be interesting is just to get a sense of how seriously did they discuss the idea of a hike, because that will go a long way to informing market views about what is the likelihood of a hike at the August meeting.
Number 4. Indonesia's annual CPI inflation rate fell to 2.5% in June, from 2.8% in May. That puts it solidly inside Bank Indonesia's 1.5% to 3.5% target band. It was also the lowest inflation print in 9 months, and lower than market expectations for a 2.7% result. ANZ Asia economist Crystal Tan says food inflation was milder than expected, with chicken, rice and shallot prices softer. Crystal says the Fed's decision on rates will be crucial for Indonesia.
The thing is, when you have global uncertainty still quite heightened, for Indonesia, the central bank will have to maintain a cautious stance. But at the same time, I think the hurdle to further rate hikes is now higher. So ultimately, for Bank Indonesia to reverse course, Fed cuts are going to be a prerequisite.
Number 5. Crystal also sees weak CPI inflation data for June out later today in South Korea. She's forecasting annual inflation at 2.5%. That's down from 2.7% in May and comes after month-on-month deflation of 0.2%, she expects. Core inflation expected to be steady at 2.2%. Remember, that's above the central bank's 2% target. Although Crystal says inflation is converging towards that target.
So if we look at inflation expectations, that's also started to soften. It looks like the conditions for an easing pivot are gradually coming together. Our baseline expectation is for the Bank of Korea to pull the trigger by Q4 this year.
Crystal tan there. Now, in the second part of our bonus deep dive interview with ANZ senior economist Catherine Birch, my colleague Alex Tarrant asked how Australia's inflation cycle compared to the rest of the world and why services inflation is proving so tough to get down.
While the headline CPI is going to look a bit wacky, there are signs that we're going to see this gradual disinflation process in Australia. Yes, Australia's inflation cycle has lagged other economies, and yes, we haven't seen the RBA raise the cash rate as much as we've seen in some other economies, particularly the US and New Zealand, closer to home as well. And look, there are some risks, and we've seen, things like in the US earlier this year where that disinflation process appeared to have stalled, and then it sort of returned to that disinflation process over the last couple of months. But there's a few offsetting factors. So, for example, higher oil prices, higher shipping prices, labour cost growth quite elevated, which will, mean that it'll be a more gradual slowdown in inflation than we might see otherwise. We're also seeing things like construction cost growth may pick up a little again, particularly with this large infrastructure pipeline that we've got on. But we're also seeing signs or indicators that inflation will continue to slow. We know that the cash rate where it is restrictive. More just it'll take a bit more time, we think, for that demand to come back in line with supply. But you look at things like some of the business indicators, for example, that is showing a bumpy path back to target. But also if we see for example, the Australian dollar appreciate, that will sort of take some of the pressure off prices as well, particularly those imported prices.
And what are you seeing or projecting in terms of services inflation? That's been a real problem around the world, including in Australia. And it seems like sort of still high wage growth in Australia is still driving that services inflation.
Yeah, we've seen services inflation easing, but it is still sort of probably a bit high for overall inflation to be consistent with the target. And we have seen quite a lagged wage cycle in Australia as well. We've got about 57% of employees either on award wages, which get reviewed once a year, or on EBAs, enterprise bargaining agreements or collective agreements, which can be locked in for 2, 3, 4 years. So often wage growth isn't quick to respond to what's going on in the labour market here. So that means it took a while to pick up, but it also might take a while longer to slow. We are seeing signs of wage growth under individual arrangements, so one-on-one sort of contracts between an employee and an employer. That wage growth under those arrangements has started to ease. We saw the award wage increase for this year quite a bit smaller than we saw in the previous year, so 3.75% this year versus 5.75% in the previous year. So that is coming down and sort of in line with what we're expecting on wage growth more broadly. But I guess it's EBAs or those collective agreements where there is a bit more stickiness. There are still some workers who have been on the same EBA for the last few years and haven't seen a shift to the larger wage rises that reflect that tightness in the labour market and higher inflationary environment that we've had recently. So there are still some workers to roll on to new agreements with larger wage increases, and that will likely partially offset slower wages growth under awards and individual arrangements, so contribute to a bit of that stickiness. But the direction for services inflation, we think, is still down, albeit potentially with some bumps along the way.
Catherine Birch there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, July the 2nd. Catch you tomorrow with the detail from today's RBA June Board Minutes. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.